Hello and welcome back to another exciting edition of Rate Desk. Today is October 7th and I am your host Michael Thomas here to talk about multifamily interest rates and other news. First, let's go to the markets today. All three indices are up and in the green. Some of the big news and headlines today regarding a House report and antitrust on some of the big technology companies that really hold what could be argued a monopoly for certain things like Google and search and Amazon and buying things, etc. So we are seeing that come out today. It's kind of a headline in the news. U.S. 10-year Treasuries, another big move we saw from last Friday to Monday, about a 10 basis point jump, one of the biggest that we've seen. They're trading now at about 78.78 basis points. But if you recall, they were, about 10 basis points below a week ago. So big move there. There's been some improvement to the unemployment numbers. Analysts are projecting that U.S. Treasury yields are going to remain low for a considerable period of time. However, it'd be nice if they would define what that new low is exactly. Clearly, if we look at the historical trend, below 1% could be considered low, but we've been below 1% now for a couple of months. So what is the new low? That is a good question. I guess we'll find out as we move forward here. Crude oil futures are range bound to where they were about a week ago at the $39 barrel range. So we continue to see them stick there. Jumping over to the multifamily interest rates. First, let's start off with the FHA 223F. We are seeing rates tick up from where they were about a week ago. So we're seeing a 2.29 fixed for 35 years. And on a new construction or sub-rehab 221D4, we are seeing those quote at 2.89. That's 2.89 fixed for 40 years. And of course, non-recourse fixed the entire time. Jumping over to the agency desk, we're seeing the Fannie Mae rates right now, quoting again in the high twos. We'll call it a 285 today, quoting on the Fannie Mae 10-year. Freddie Mac quoting at about 305 on 10-year money. Was speaking to my friend over at the agency desk today, and they are seeing some pretty good incentives on the Freddie Mac product for green, energy efficient, according to Freddie Mac standards. Used to not be as competitive. Now seeing borrowers are seeing some pretty good reductions, about 15 basis points to their interest rate if they go green on the Freddie program. Speaking of that, going over to other news, I do want to talk about green incentives for HUD. As I've reviewed the draft guide, we do expect the new FHA map guide to be issued at some point this year. I want to mention that if you're developing without a HUD loan for construction and permanent, but you are considering a HUD loan at takeout, you're going to want to look very closely at the green energy standards that HUD is going to measure in the new map guide. The reason I say that is it could be an easy tweak during construction to switch from LEED to, say, one of these other new approved standards that HUD has. But if you don't do that, it's going to be harder on the back end to now try and translate what was done if it wasn't to a standard that is allowable in the new map guide for HUD to determine that your project was built energy efficient. That's just kind of a word to the wise, something that I've noted. Of course, we don't know until it's fully issued what the final map guide is going to say, but it does appear that that is one of the considerations you might want to keep in mind going forward. Next, I want to mention financial leverage. Just be cautious. We are in a low cap rate environment, and if we do see these interest rates tick up, there is the risk of financial leverage, meaning your loan constant, or as HUD calls it, your sum of rates, is going to exceed your cap rate. That's a place you don't want to be, but just be cautious and aware of kind of where we're at in the market, again, given the low cap rates. And then if there are any upticks in interest rates, something you really want to pay close attention to. I'm also looking at some stuff in the urban environments, and it made me think, it's a good time to consider HUD in the urban markets, especially some of the larger ones, Denver, LA, San Francisco, New York. A lot of times HUD is sort of the lender of last resort in those markets for a variety of reasons, but one of which is that private equity tends to dominate the institutional equity markets. They have their own sort of preferences on debt, don't really have the time or energy to deal with government restrictions. But a lot of that money has dried up recently, not focused on the urban core, kind of moving out more to the suburban markets like we've talked about in previous episodes. So you want to keep in mind HUD in these urban environments. One really cool thing is if you're in a zone in a city where it's been under redevelopment, or maybe it's been upzoned, or it's in any kind of a targeted development area, that could qualify for HUD's 220 program. It's different than the 221D4. You do have to be in an identified zone, some type of a renewal zone. And if you can prove that to HUD, you are able to actually use a lot more commercial income. So this is great news for those mixed use projects that developers are working on, where they've got a pretty significant amount of commercial income. The 220 program allows you to add an additional 15% over what you're allowed to do in a 221D4 program of commercial income to your effective gross income, your EGI. So huge difference there, immensely helpful, in particular because Denver, LA, a lot of the bigger markets are what we call in the HUD lending world statutory constrained. That means your loan is limited kind of by these stats, that were artificially created. And in order to exceed those, one method is having more commercial, because those commercial costs are costs not attributable to those stat limits. Long explanation, however, do think it's worth considering. I am starting to see more of these urban core and mixed use deals. I know other lenders are as well. And again, that's a bit more unusual in our world, when typically there's been so many institutional choices in that market, and they've really preferred those very, very low leverage construction loans, maybe 55, 65%. Remember, if you're cost constrained, you are able to get up to 85%, but it's unusual that you'd be able to do that in an urban core. So likely you're still going to be well in excess of what traditional bank financing would be at, but of course it's deal dependent. So ask your lender, size that up for you. That is my tip of the week. Thank you all so much for tuning in to another exciting edition of Rate Desk. I am your host, Michael Thomas, signing off.